On May 1st, there are changes coming to fees on mortgages backed by Fannie Mae and Freddie Mac that may be one of the most damaging things to happen to housing stability in years. I'll explain why after this. What's up, everyone? It's Jeff with Jeff West Properties, your host for the Conroe Living Channel, where we identify and celebrate everything that makes Conroe, Texas, one of the fastest growing cities in America. You may have heard in headlines or on social media lately that at the beginning of the month, the Federal Housing Finance Agency is going to change their fees in a way that's going to hurt some people with good credit while helping other people who have bad credit. Now, there's been a lot of speculation as to what it really means and a lot of misinformation that's out there. So I'm going to break down what it actually looks like and why it could be incredibly damaging. Now, in saying that, it's important to understand that I have been one of the people since 2020 that have been putting out market updates that have tried to bring perspective to some of the inflammatory headlines claiming that the housing market's going to fall apart. There have been a lot of people who have been using data to explain why the housing market is about to fall apart, and my videos have sought to answer why I don't think that's the case. Now, I don't claim to be an economist. I don't have a crystal ball saying what the future of the housing market is really going to look like, but I study a lot.
I'm a student. I like learning.
I read every article that's out there from as many different sources as I can to try to find out why people are coming up with the predictions that they're coming up with. Now, I should say that I have been pretty spot on since I started market updates in 2020 about what was happening.
Because I'm a very smart guy.
With the one exception of not knowing just how hot the housing market was going to get. And to be fair, no one else knew it either. Since the beginning of 2020, you've had people pointing to job losses, or especially the extreme unemployment rate that happened during COVID, as a reason that the market was going to soften. Now, my perspective answer to that was that, number one, those job losses were temporary. And number two, most of the job losses occurred in sectors like the entertainment, restaurant, hospitality, gigging industries. And to be completely fair, a lot of people in those industries didn't own houses to begin with. Not saying that none of them did, but a lot of them did not. Now, on top of that, we also had forbearance for people with mortgages to help stave off some of the possible foreclosures that would be coming if people couldn't pay their bills. Of course, we can look back now and say not only were those predictions of a crash wrong, but the exact opposite happened, with the average home appreciating more than 40% in a 3-year period. So then the cry became unaffordability issues are going to be the reason that the market's going to tank. They said that with the extreme rising interest rates, it was going to soften the market by drying up the buyer's pool. And my response to that was that home builders in America were going to be an important catalyst to keep the industry moving and maybe even bring us out of the slump by doing things like offering to buy down interest rates or offering great financial incentives, making it easier for people to get into homes and keeping the industry moving. So then there were those that said, well, that doesn't matter because there's no buyers out there to actually take advantage of these incentives. My response to that is, yes, the buyer's pool has dried up a little bit, but guess what? There's no sellers either. As of this taping, we're still sitting nationally at about 2.7 months of housing inventory, which is far lower than the 6 months of inventory that it would take to be considered a balanced market. Most people who own their homes are sitting more than likely on a 4% or less, as little as 2.5% interest rate. So if they don't absolutely have to, why would they sell their home and the interest rate that they have just to purchase another one that's going to be at 6 or 7%? It just doesn't make sense. So people have been staying put. But the argument was, well, some people don't have a choice but to sell, and that's absolutely true. So the fear was those people who had to sell and were desperate were going to pull their prices down in order to be able to sell, to find buyers that aren't out there, and that was going to bring down the overall values in areas. And in some cases that happened. In my market, for instance, in Conroe, Texas, and Montgomery County specifically, we have one zip code, 77302, that actually lost 23% year over year in March. Pretty substantial. But it would take another video to explain what was happening in that particular area because overall, Conroe's housing market has appreciated since last March. And if you look at the national average, right now in March, year over year, we have lost about 3% from the peak. Yes, we've lost a little bit, but take into account that most projections, including my own, were that we would end up at about 1 or 2% loss on the year. Not really much of a factor. And we haven't hit the spring buying season yet, so we're well on our way to hitting that projection. We're not really gaining anything this year on the national average, but we're not really losing much either. In fact, nationally, we are still seeing that 28% of homes sold from March of last year to this year have sold above the list price. So there are still multiple offer situations going on now. It's not as much as we had during the height of the housing craze, which is 60, 70%, but it's still a seller's market. Hey, sorry to interrupt. If you're liking this video, make sure to hit the like button and subscribe. It helps my channel to grow. Okay, bye. So then some of those same people said, well, now we have all this inflation. With everything being more expensive, people aren't going to be able to pay their mortgages and they're going to default. I don't think that anyone would disagree that prices on pretty much everything have kind of gotten out of control, and it has made it a lot harder to make ends meet than we have experienced in the past. A recent poll showed that the majority of Americans have less in savings right now than they did in 2021. And a lot of that is due to people having to dip into their emergency savings to weather this financial storm. But there were two answers as to why that wouldn't really have an effect on home prices. Even if people got into a bind with being able to pay their mortgage, remember that in the last 3 years, the average price of a house has appreciated 40%. Now, with all that equity, it gives lenders a lot of options as to what they can do when people stop being able to pay their bills, and the homeowner could just sell it outright and still make money. Now, yes, there have been some markets that have been affected more than others around the nation. You're looking at Boise, Idaho, Austin, Texas, Phoenix, San Francisco, that have had as much as a 15% depreciation in the last year of home prices. But keep in mind that the average home price appreciated 40% during that time. And in those markets specifically, it was even more so because they were the hottest markets in America during the buying craze. So even at a 15% decrease, those houses are still significantly above where they were 3 years ago. And the other thing is that today's homeowners are very well qualified to carry mortgages. There are tight regulations put in place for people to be able to borrow money to pay a mortgage. Most of them have cash reserves, and the vast majority have very good credit ratings. When people have good credit ratings, it's because they know how to pay their bills. And if someone is responsible enough to keep their credit rating up, that means that when times get tough, they figure out other ways to tighten the budget aside from just not paying their bills. But that issue is what brings me to today's topic. 15 years ago, Fannie Mae created the loan level price adjustment after the Great Recession, the housing crisis of 2008 to 2012. The loan level price adjustment formula was such that people with lower credit, with riskier loans, had to pay higher fees to get a mortgage, and people with higher credit rating received more favorable terms. As of May 1st, the loan level price adjustment is going to change in a way that's going to benefit people with lower credit and penalize people who've got better credit. Now, I do want to break this down because there have been headlines and things on social media that are mischaracterizing what this really looks like. And just to make sure this is known, no, people with low credit scores are not going to get more favorable terms than people who have good credit scores. What it is doing is more leveling the playing field by lessening the fees of people who normally would pay the most in fees because of low credit, and passing on some of those costs to people with better credit. Let me show you the matrix to see what I mean.
Let's go.
What you can see from this chart is the new rates are going to be favorable for some scenarios and worse for others, with the areas in red actually seeing higher fees as of May 1st, and the scenarios in green having more favorable terms than before. So to dispel the narrative, you can see here that the person with the lowest credit score, financing is the highest amount at 97%, with the highest overall fees of 1.75%, compared to people with better credit.
And I show you how deep the rabbit hole goes.
The people most negatively affected are those with credit scores between 680 and 780, especially those who are putting 20 to 25% down. So those people who have worked hard to improve their credit and save up a big enough down payment are the ones being most negatively affected by the change.
I don't believe it.
Now, you can find a lot of videos out there, a lot of articles out there that explain why this is just a very unfair change that they're making. And I'm not going to focus on that right now. I do want to point out why I think it's a bigger deal for the industry as a whole. The goal of these changes ultimately is to make it easier for people with lower income, but more specifically lower credit, to be able to achieve the dream of home ownership. Now, I personally am all for any way to make people that are more socioeconomically challenged have opportunities to buy into the American dream. But in this scenario, we're not just talking about the poor or the impoverished. We're talking specifically about people with low credit scores.
There could be a problem.
Like I said before, people with high credit scores have that because they pay their bills. They figure out a way to take care of their responsibilities, and they have established themselves as people worthy of credit. There are different circumstances as to why somebody may have low credit. In some situations, it's just that they have no credit. They haven't established it at all. I've had potential clients that couldn't get a loan because they paid for everything in cash, which was a very good, very fiscally responsible thing to do, but it left them unable to establish credit, and they couldn't afford to buy their houses in cash. So we had to come up with a different solution. But for the vast majority of people with low credit scores, they have that because they have defaulted on their credit worthiness. They haven't paid their bills like they're supposed to. Sometimes it's because they've had high medical bills. Sometimes it's because there was a job layoff, a divorce. It happens. I'm not shaming anyone with low credit scores, but I am saying that it's a big problem for credit worthiness because they have shown to be a risk. We've already established that home prices are at all-time highs, and now this program is going to try to make it easier and more accessible for someone with a low credit score, therefore a more risky loan, to be able to get a loan. What happened the last time we tried to make getting loans as easy as possible? I can't remember. It seems like so long ago. Oh wait, it wasn't that long ago. We had the Great Recession.
Fate, it seems, is not without a sense of irony.
The Great Recession happened in large part because lenders were giving out risky, irresponsible loans, and those people who never should have had loans in the first place were defaulting on them, putting those houses back into the market. And as they trickled back into the market, it lowered everybody's overall home values by creating more supply than demand. The end result of that is that some people in America lost 50% of their home's value over that time. Now, since the housing market recovered, for the last 15 years, government oversight and tighter lending practices have been responsible for keeping the housing market healthy. The goal in all of these practices is specifically to keep us from having what happened back in 2008. To me, this change in lending policy seems to be opening the door to have exactly what happened before happen again.
You're afraid of change.
Now, I can't claim to understand everything about it, and maybe there's something I'm missing. If you have any other take on it, let me know in the comments. Even though the policy goes into place May 1st, lenders may be slow to adapt to it, so it may take a little while for us to see the end result of loan level price adjustments. I promise you I will continue to read up as much as I can on this and get the real world data to see how this is affecting the housing market in the near future and possibly in the farther future. Again, as you can see from my track record, I'm not someone who preaches doom and gloom in the housing market, and I don't get affected by negative headlines very easily. I very much hope that I'm wrong, but this one concerns me.
All I'm offering is the truth, nothing more.
Hey, if you want to talk real estate, anything having to do with buying, selling houses, what the future looks like, I'd love to give you as much insight as I can. I'm a relocation specialist who's helped people from all over the nation relocate to the state of Texas. Also, if you're interested in learning more about the fastest growing city in America, Conroe, Texas, make sure to subscribe to the Conroe Living Channel. On the site, you're going to find everything that makes up the DNA of my hometown. This video is a good place to start.